right. Well, we're going to start today I like to call the Oklahoma City Post-Employment Benefits Trust for February 12th, 2025. I'd like to call it to order. We have item number 2, which is approve the minutes. We have 2 sets of minutes, so we have the November 13th and the January 8th minutes. And I think we'll do them all at once, correct? All right. Entertain some motions. Here. Record your vote, please. Passes unanimously. Now we're on to item number 3, items for individual consideration. And the first one will be item A, and we're going to see our actuarial report valuation from Nyhart. And we have John Mallows from Austin, Texas here.
Thanks for having me here today. See, can I control this or no? Oh yeah, okay. All right, I'm going to start off on the summary page here. As you can see, we have some good news. Liabilities came down. The assets had a good year and they're up. So the funded position of the plan has improved quite a bit in the last year. And I'll get into the reasons for the big decrease in the liability later, but yeah, it went from 26% to 43% funded, and COTPA went from 59.5% funded to 81.3% funded. So overall, a pretty big improvement, and you can see for the participation actually stayed pretty stable over the last year, so that wasn't a factor. It was a very small factor in the improvement. I think it was like a 1 or 2% improvement because of the census data. Oh, and I should also mention this is a roll forward year for COTPA, so we didn't actually get new census data for COTPA. We used last year's census data. So this just has the detail, the breakdown between pre and post 65 and retiree and active liabilities. But I'm not going to spend too much time here. Okay, I want to spend most of my time on this page here because that shows how we got from last year to this year. So we started at the liability side. We started at 356 million, and then we added service costs, which is the costs of covering actives for the year. They get 1 year close to retirement, so we have to accrue some benefits for them. And then we had interest, like interest on a mortgage, so that was 19 million. But then the big changes were differences actual expected experience minus 41 million, and change in assumptions minus 81 million. And finally, benefit of payments, it's 15 million that releases some liability. So when you add all that up, it takes you down to 244 million. And on the asset side, we started at 93 million, and then the contribution of 13 million that we should be making every year for the last few years was put in, and that had a good investment return. So it's now 13 million, and then the benefit payments came out of that, and the trust and the administrative expenses. So overall, there's an increase from 93.7 to 105 million. So yeah, go ahead.
John, if I could ask you a couple of questions. If you go back up to on the liability where we went from 20 million assumptions of decline. We went down $81 million. What drove that one, and then the difference between expected and actual? I mean, kind of self-explanatory, but if you could give us a little more insight into that, that'd be great.
Okay, yeah, sure. Well, first I'll get into the difference between actual and expected. That was mainly the premiums coming in flat or lower. So there's we expected them to increase with trend like at 7.5%, and they came in flat. So there's a big gain there. And that actually had a compounding effect because we also because of the gains, we're able to raise the interest rate we use, the discount rate, because we project out into the future. And now, because of the gains, the fund's at this point where if you project out contributing what you're contributing now, you actually have enough money in the fund to fully fund all the future payments, assuming those contributions continue. So that means we can actually use a 7.5% return, which is up. I can't have the number here. I think it's 5.3 or something like that. It's on the next page, but because of that, then we can use that lower return. There's also a little bit of the change in substance offset a little bit because we're doing it late this year, because we didn't have the data until late. We actually took into account the 2025 premium increases, and they actually increased quite a bit. So that's kind of in that trend assumption. That falls into the assumption bucket, because they actually had, I think, 14.9% increase in premiums. So so they increased a lot more than we thought. So that kind of offset that.
So that impact is,
to build.
if you get the data normally, like you normally get it this next year, will that negatively impact that? Or do you?
We just won't, we already know it, so it'll be the same.
Okay.
Unless, unless we can find out the 2026 premiums, but we usually don't have those to be able to do this, so.
Okay.
Okay, so I'll move on. COPPA is the same story. Service cost and interest gets added, and then there's a similar change in assumptions, which is mainly the discount rate. And it also had a gain on experience, not quite as big because of the flat subsidies. So some of the decrease in the premiums didn't impact as much, but overall, it's still a decrease. Liabilities down to 1.8 million. And the assets also did fairly well. And ended up increasing the fund by 337,000. So, the funded position actually increased to 81.3 from 59.5. So, still a very good result there. Let's see. I'll move on to the actuarial determined contribution. We do calculate actuarially what you should contribute. You haven't been following that, which is fine. It's just a recommendation. You don't have to do it, but the actual contribution, we'd recommend you contribute 1.7 million more than you do, but it's still doing a good job, contributing the 13.3 million. And that deficit is decreasing over time because of the good experience that you've been having. Similar situation with COPPA, deficit of 21,000, which is still pretty close to the actual contribution, so it's still a good funding level there. So move on to the OPEB expense, and actually it's a negative, so it's really an OPEB asset, but it's built up by the same service costs as in the previous page, and same interest costs. But then you have those gains and losses get amortized over several years, so you bring them in gradually. And then you also have the OPEB administrative expenses. So it didn't change that much from last year. You still got all these gains that you're kind of phasing in over time, so that should continue into the future as you keep having gains. But so increased about 8 million, the OPEB expense. So. And then COPPA is, similar, service costs and interest, and offset by projected OPEB returns, the asset returns, and then you add the expenses, and then you've also got some gains that are coming in over time, so they get phased in. So again, you have a negative expense at the end of the year. It was positive last year, a small positive, but now it's a negative number, which is good. And this just shows the detail of all the gains and losses that are still coming in. You've had gains in the last 3 years, so they're still coming into expense. So the expense should probably stay negative for a while yet. So as they until they get phased out. And Cottbus, not quite as big a gains as a city, but still you got some gains to phase in. That helped to keep the OPEB expense down. And it just shows the sensitivity to the discount rate that we use. And I should say, the 7.5 is supplied by, I believe, the investment advisor. It's expected return on assets, and that's what we use. It seems reasonable considering. I think you're invested fairly aggressively. So let's see. There's another. And then this just shows the asset breakdown detail. I'll skip through these. And then here's the calculation of the ADC, which is a little bit higher than your benefit payments, but not too much. Again, this is just a recommendation. Actually, we're projecting it next year to actually fall below what you're contributing, so that's good. I'll move on. And this is just we show the projection, our projection for next year, assuming that all the assumptions are met and there's no gains and losses. And we expect the liabilities to actually grow a little bit. And then here's the projected cash flows. You can see how current retirees, as they get phased out over time, but they get replaced by future retirees. The same thing for COTPA. Sure.
The previous. Yeah, it doesn't show the full amount of time it takes to get down to zero, but yeah, probably not 30, 40 years. Yeah, right. Not to be, it's just the reality of
Wow, you really know how to.
it. No.
dance.
You want to have a good party here, right?
It's
So,
all
yeah, sorry, but.
Yeah, because the plant's closed and you're hired, so. Yeah, okay. Yeah, so here we just show our development of the discount rate. We don't use the bond rate anymore because of as I was saying earlier about that projection showing that it actually covers all the future cash flows. So we don't need to do that. And that could change. If you have losses, say next year, then it could actually flip back. We have to start considering the bond rates again. And it shows a summary of the participants, and that really didn't change too much from the prior year. We had to hash out some. We had some people we were including and some people we weren't including that kind of offset each other. But overall, the population is pretty stable. And here it just shows the planned visions. Here you can see how the premiums didn't change. From you say flat, which was a big reason for the gain, because we expected them to increase with the trend assumption, but they didn't. the subsidies stayed the same as prior years. Yeah, here's a big change in discount rate. And we didn't change any of the other demographic assumptions. I know we talked about maybe doing a experience study last year, but you decided not to go forward with it. But we can always do that again. We can look at that again fresh if you want to. Let's see. Yeah, they say the same. Oh, one thing I want to talk about is the trend assumptions. And the post 65, I'm a little concerned about, just because I don't know what's going to happen with Medicare. You know, the new administration, you know, if they make big changes, that could impact premiums. And it's impossible to say what's going to happen at this point, but you know, I think there's a possibility that, especially for Medicare Advantage, you know, some major cuts to the Medicare Advantage reimbursements, and those premiums could go way up. But again, it's just we just don't know at this point. Let's just see how it plays out, but it's something to keep an eye on. So for now, these assumptions are assuming that there's going to be no changes to Medicare. And then here we show the per capita costs. It didn't change too much from last year because the premium stayed pretty flat. And yeah, and I think that's about it. Do you have any specific questions?
Any questions for John?
And I'm going to continue monitoring the Medicare situation, and we may end up adjusting those assumptions next year, depending on what happens.
All right, and I think all we do is receive this, so there's no voting on this item.
No, you have to still vote to
We
receive it.
still have to receive it? Okay. All right. Record your vote. Passes unanimously. All right. Thank you, John, for making the dangerous trip from Austin, Texas to Oklahoma City today. We
You're
appreciate that.
Wasn't
Thank
too
you.
bad, so.
All right, now we have item 3B. We receive our quarterly investment report for the period ending December 31st. We have Jason Pujols here.
Thank you. Good afternoon, everyone. Got a few things today. I'll start with the quarter report for the year ended December 31, talk about results, and then we'll transition, talk a little bit about asset allocation, kind of ties into the actuary discussion on the discount rate, and just forward-looking our expectations, which are probably for the next decade a little bit lower than that 7.5% assumed rate of return. And then finally, finishing up with some modifications to your policy. Just wanted to start on this page. It really will explain your results. Looking back over the last year and really the last decade, they've been very strong. As you see these bars and the data in the table below, this represents returns of various market indices. If we go all the way over to the 10-year on the far right, that gold bar, the fourth from the left, is the S&P 500, our large cap U.S. stocks. This portfolio has a very large allocation to U.S. large cap stocks. It's your largest by far. It's about a 60% overall allocation. It is the best performing asset class by far over the last decade. Certainly if we look at the last year, large cap stocks up 25%, the next best asset class. The ACWI that you see there, that includes U.S. large cap, so that's not really indicative, but small cap up 11.5%, so very good absolute return, but less than half the return of large cap. And over a decade, small cap up 7.8%, so above that 7.5% hurdle rate, but about 60% of what large cap has done. So really that's explained your results on an absolute basis and a relative basis to policy and peers. When we look at peer group data, this portfolio, backward looking, top 10%, really top 5%. That's because you have more of what's done best in the rearview mirror. As we're looking forward, one of the things that we're proposing is having a little bit more definition around large and small cap and non-US, and perhaps bringing that down a little bit to better reflect overall market opportunity. And I'll get to that in a moment. So then I'm skipping a number of pages, looking at results versus objectives. These objectives are spelled out in your policy for the total portfolio from a return standpoint. These are all return-based. There's, at this point, there are no real risk objectives, but the portfolio is expected to equal or exceed CPI plus 4%, because as you just talked about, healthcare costs going up, exceeding CPI or inflation over time, so we need to get a premium to that. Over the last 5-10 years, this portfolio's done that pretty well. You see the yeses, which is very black and white. You've outperformed that CPI plus 4%. Outperforming that 7.5% actuarial rate of return over this last 5 and 10 year period, the portfolio's done that. As you'll see in a moment, when we look at forward-looking expectations, that's going to be a little bit more challenged. As large cap U.S. stocks, our expectation over the next 10 years is much lower. It's actually lower than 7.5% when you take into account volatility or risk in the portfolio. Then simply outperforming a T-bill, which we would expect, and then outperforming the policy index. This portfolio actually has lagged the policy index. The reason for that, your policy index is only the S&P 500 for equities, and you have a little bit of small cap and mid cap that hasn't been up as much. So there's a bit of a mismatch there. Nothing that would cause us concern. Finally, looking at where we are today in terms of allocation versus your current targets, you'll see here we just say U.S. and non-U.S. equity. That's how it's currently defined in your policy. There's no breakdown of large cap or non-large cap or small cap within the policy. 60% target to U.S. equity. You're really right about on that, 58%. We've done a little bit of rebalancing as you had gotten over that, so we brought that down a little bit. Non-U.S. equity, a single manager there, 10% target, a little bit overweight, but well within ranges. Within fixed income, you have a target of 30. We're right just essentially slightly below, about 40 basis points. We have done some rebalancing, taking from equities and adding to fixed income. Also, you have currently targets to high yield and the long government credit. I think you call it, it's the Hoisington strategy, which is active duration is how you've defined it. You have in the current policy targets of 3% and 9%. High yield, you did have the lower end of the range at 0, so we did eliminate the high yield. That went away because you're getting quite a bit of high yield in your core plus managers, DoubleLine and Loomis. One of the proposals today in the policy is simply to have a target of 30% to core plus, eliminating these subcategories, which would then most likely dictate the getting out of the active duration strategy. On a dollar basis, it's a little bit different time period than what the actuary was showing. Their time period was ending end of your fiscal year, which is in June. This is the end of the calendar year, December. So you'll see the 1 year started the year with a market value of $102.1 million. Net additions, this is any contributions into the trust, less money coming out for benefit payments and otherwise. We would expect this generally going forward to be a negative number as you're using funds from the trust to offset some of the pay-as-you-go in the trust. The return on investment on a dollar basis for the year, 13.7 million, ended the calendar year a little under 113 million at 112.8 million. As you all know, this trust has grown dramatically over the last decade due to funding and positive performance. And you see that number here from 29.2 million to 112.8 million over that last 10-year period. That's a pretty nice chart to see. Kind of you see the path that you're going. 2000, you see COVID here. You're going to have downturns along the way. The interest rate increases in 2022 as rates went up. Both equities and bonds sold off, and then you've had a pretty nice climb from that point to the end of the year.
When you go back to that one, I'm sure Laura can give us some insight if you go back to that one. From September '09 to roughly November of '10, you might have thought maybe we should have put it in a coffee can and put it in the backyard.
We absolutely, yeah. It was very frightening, yeah.
And it was something that influenced the Acmeot Trust decisions as we got that trust going too, yeah. You know, when you start with the worst possible market conditions, yeah, it's not good.
Right, right. This is just looking at results versus policy and peers. We're comparing you, it's not necessarily apples to apples here. These are public or government-defined benefit plans. There's not a robust enough universe of just OPEB trust, but it's similar in size, 50 million to 250 million, so the ability to diversify in what they're doing and looks similar to what you're able to do with your size of assets. These rankings, these are where this portfolio ranks relative to those peers, and you'll see really top 10% over the last 1 and 3 years, so the lower the better. That means on a one-year basis, this portfolio had a better return than 89% of the others in that universe, and over a 10-year period, better than 94%. This is really a reflection of the asset allocation, and you have more of what has done the best looking backward, more U.S. large cap, and quite a bit more than peers over that period. Sometimes that's good, sometimes that's bad, right? So with that, I'm going to switch over now, unless there's any questions on results through the end of the year, to the asset allocation piece, the forward-looking. Really,
How about we go ahead and receive the item 3B? Would that be okay? Want to do that? So I would entertain a motion to receive item 3B.
and if you want to receive 3C as well, I won't
Okay.
go over those unless you want me to.
Record your vote. There we go. Passes unanimously. Now we'll receive the monthly investment reports for, are you going to go over the January 31st one?
I wasn't going to just roll a month forward. I thought the other two items were more, but I can touch on it if you want me to.
You can give us just a brief one, I think. That'd be great.
Sure. Returns were positive in the month of January. See if I can pull it out of here. I have it tucked in here. Oh, there you go. So up about 2 million in the month of, or 3 million in the month of January, 115.9 million. So another good month. You'll see total return for the month up 2.66%. So now the trailing 1 year up 17, 10 years up 8.44. So you added a good month. And that return coming from a little bit different areas. Small cap outperforming, small cap growth. One of your best was your best performing manager on the month, as we saw some of the large cap names particularly the mega cap. Magnificent Seven sold off a bit in the first half of the month. While large cap was still positive, you see mid cap and small cap outperforming, non-US equity outperforming large cap on a relative basis.
Okay, does anybody have any questions regarding the January one? All right, then we'll entertain a motion for item 3C for the 3 monthly investment reports. Item passes unanimously. Now let's go to item 3D, discussion of asset allocation and portfolio implementation. On this item, there will be no action taken. He's just going to do some explaining.
This is really educational, informational, ties into the discussion with the actuary on your discount rate and just setting expectations. It also ties into recommended modifications to the investment policy, which is the next item. Just to reframe, because I think we've talked about this a couple times since we've been here with you, we update our capital market assumptions once a year. These are forward-looking assumptions, and we have 2 different time horizons that we utilize, what we call intermediate term time horizon and then long-term. Intermediate to us is still 10 to 15 years. Those intermediate assumptions are anchored more on current yield in the bond market and current valuations and equities and current cap rates and valuations for real estate or real assets, which we don't have in this portfolio. Long-term capital market assumptions are anchored more on very long-term historical averages of different asset classes. There's 3 components that go into asset allocation modeling. 1 is return, 2 is a risk measure of volatility or standard deviation, and the 3rd is correlation. And correlation is a statistical measure of how one asset class behaves in relation to another. In building a portfolio, you can actually lower the risk of the overall portfolio when you're combining what may be a riskier asset class to other assets in your portfolio because they don't behave the same. So the optimization in the portfolio is a little bit different. The one thing I want to point out here, because in the actuarial report, they do a fairly simple calculation on expected return using the average, what we call the arithmetic average rate of return in any one year versus when we look at output of the asset allocation model over time, 10, 20 years, that is looking at geometric returns. And not to get too caught up in the math, but you'll see what the impact of that is here in a moment. So I'll use large cap as an example, large and small. So you see large cap, the intermediate term average annual return is 7.96%, which means on average in any given year, we would expect there to be a 50% chance of getting just a little under 8%. That's the median on average, with a standard deviation of 17.72. What that really is saying is that we're pretty confident that that return is going to be 7.96 plus or minus 17.72% in any one year. That's really wide. Over time, that is going to narrow closer to the average. Small cap, to use that as a comparison, you'll see on the next page, the average annual return in any one year, so this is, again, the 50% probability on average from year to year is a little under 10%, but the standard deviation is 21%, much higher, okay? So on this page, what we're showing here that is probably more reflective and more instructive of what we should expect over the next 10 years are the geometric returns, the annualized returns for each asset class over a 10-year period. So for large cap, remember I was saying that was almost 8% with a 17% volatility. That volatility erodes the median over time down to 6.8%. So really our expected return over the next 10 years for large cap stocks is a little under 7%. It's lower than your 7.5% return. For small cap, that 9, almost 10% return.
So Jason?
Yep.
So when John tells us from actual standpoint, we went from 26 to 43, I think was what it was? 43, assuming a 7.5, and you're saying we may not hit that 7.5. So would it be fair to say that our 43 is potentially a little overstated?
Well, I mean, it's not now. I mean, it's a.
As of June 30, 24, it's fine, right?
It's a point in time. He also talked about doing an experience study and looking at assumptions. So this is part of looking at those assumptions
Okay.
and determining, is that 7.5 discount rate, are you comfortable with that from a reasonable standpoint? And you'll see, based on our asset allocation modeling, over the next 10 years, the probability of 7.5 is a little under 50%. So arguably, some would say, well, that we'd rather have that probability be over 50%. So might ratchet it down a little, that assumption down a little. So this is more an exercise of what's reasonable. We know one thing we're certain of is we're going to be wrong on what the median is, but we're pretty confident that we're going to be somewhere within a range. So this page is looking at something a little bit differently to consider when we're establishing our asset allocation targets. So the math, if we looked at just the math, we'd say large cap, that assumption's coming down. We should probably have a little bit less there. International is a little bit higher, so arguably we should have a little bit more. But we also want to be thoughtful about global opportunity set. Now, your portfolio is pretty significantly skewed to U.S. And U.S. large cap relative to the opportunity set. What this is this is looking at 3 different indices, and really it's just these 2 on the left that are relevant here. The MSCI ACWI is a global equity index. As of the end of 2024, it was about 2/3 U.S. and 1/3 non-U.S. So when we think about how we should implement the portfolio, typically we want to be closer to neutral to that opportunity set. Within the U.S., the Russell 3000 is a benchmark that is representative of the broad U.S. equity market, large, mid, and small. Large cap represents about 72% of that opportunity, and non-large, so small and mid, represent about 28%. And then I won't get into developed and emerging for this discussion. But again, we'd like to define these to be pretty close within our asset allocation to these numbers. So today, your target, this is your investment policy target. What says target here? And you're defined 30% broadly to fixed income, that's 18% what you call core, but DoubleLine and Loomis are more core plus managers. They have the ability to invest some in high yield, some non-dollar denominated bonds, some emerging market debt. 3% target to high yield and 9% to, we're using long government, you call it active duration, but it's the same thing. The policy has a 60% target to U.S. equity, not defined between large and small, 10% to non-U.S. equity. That portfolio mix, based on our median return, our capital market assumptions, has a 10-year median return of 6.75. What that means is there's a 50% probability that mix is going to get 6.75% or greater, and a 50% probability that it's going to be 6.5% or less. Standard deviation of about 12.8%, which is a measure of risk. These are useful in terms of comparing one to another. Sharpe ratio, which is a measure of efficiency, looking at one asset mix versus another. We'd like to see a slightly higher, you want to see a higher Sharpe ratio. That would mean more efficiency. Over 20 years, I mentioned earlier that our intermediate term assumptions are looking at 10 to 15 years. Our long-term assumptions are looking out longer. The way the model works when we're modeling beyond 10 years, it's going to blend the intermediate and the long-term assumptions together. So over 20 years, the probability of 7.5 is much higher. You're at 50%. If we look down here, this is the consideration I showed on the prior page, to looking at benchmarks in the opportunity set. So currently, your portfolio targets are 86% US, 14% non-US, which is pretty significantly off this 2/3, 1/3, if you will. Within US, large and small is undefined. So what we're doing here is simply trying to bring the portfolio a little bit bringing the portfolio a little bit closer to those, the global opportunity set. So defining large cap, 35%, small cap at 15, and actually bumping up your non-US equity exposure from 10 to 20. It's doubling it, but that's still going to be a little bit more tilted toward US. Didn't want to go all the way there, but and a little bit tilted to large. It's really in line, large and small, brings large and small in line in the policy. From an implementation standpoint, you are already doing, you have some non-large cap, mostly mid cap, not small cap, but this better defines it in the policy. The point of this is, if we look this mix versus the current targets, slightly better return, same amount of risk, the Sharpe ratio goes up a little bit. First percentile return, what that is worst, think of that as worst case scenario in any 1 year. That's not over a time horizon. So you're not going to be happy if that 1 year is -26 or -25, but that's showing us there's a 1% probability that these mixes are going to be down that much. This is probably a better way of looking at things, looking at a range of the distribution of outcomes. This is the 1 year, and this isn't next year. This isn't any 1 year, the range of outcomes. The 50th percentile in any 1 year, which would be tied closer to those arithmetic returns, is 8.3 to 8, or 8, let's call it 8.4% for either mix. They're effectively the same. But from the 25th to the 75th percentile, meaning there's a 50% probability we're going to be somewhere between flat to up 16.5% in any 1 year. As we move out further in time, you see the outcomes are going to narrow closer to the mean, and as we get out over 10 years, it's probably we're 4 to 9% is the, so the last 10 years, if we're looking backward, your 8.6% return, I think, at the end of the year, that's going to be somewhere up, that's falling somewhere up here. It's within the range of outcomes, but it was a good period. What we're saying is, going forward, expectations are a little bit lower over the next 10 years from a expectation standpoint. This looks at probabilities, and again, over 10 years, we're highlighting that 7.5. Either one of these mixes, the probability of getting to 7.5 over the next decade is it's less than 50%. Mix one, which again, mix one we don't look at as a change, it's more just definition in the policy. It's a little bit better. So somewhere, as you have this discussion on assumptions, considering something maybe a little bit lower than that 7.5 is probably reasonable going forward. I know certainly the defined benefit plan has done that in a much more conservative position. Any questions on this?
I do have a question. And I'm just thinking about it, so I'm not sure how to characterize it, but I guess, I appreciate the fact that we're talking in aggregates and trends and long history and knowledge of things. It seems like right now things are a little bit politically chaotic, especially in terms of tariffs. And I worry about a non-US position and whether or not there's been any analysis of that. I don't know how you would analyze it, frankly, because it's so changeable over the last few weeks and it's a pretty short time horizon. But if there's any experience, I mean, it's not the first time the US has done tariffs. It's not the first time foreign countries have done tariffs. Is there an effect that we would see on those non-US markets that we should take into consideration as we're thinking about rebalancing?
Have this conversation. This is a question that comes up in every meeting right now when we're talking about asset allocation. First off, I want to, we're not talking about rebalancing necessarily. We're talking about policy targets.
Right.
Rebalancing is a second order of that, if you will.
Yeah.
So the policy asset allocation targets are intended to be strategic, long-term.
Right.
Expectations regarding or geopolitical risk are baked into the numbers. If we look at non-U.S. equity, that's why you have a higher standard deviation for non-U.S. equity than we do for U.S. If we saw emerging markets, it's going to be, which we didn't include here, that's even higher. So that those risks in the short term, medium term, long term are incorporated into the numbers in the model, and that, you know, that could impact where we fall on this distribution in a 1 year period. That's why this is so wide. From a tactical rebalancing, I think what we would stage into that, looking at that, because right now you're at 10, we wouldn't just go from 10 to 20 overnight. We would stage into that over a period of time, but not there's not some moment in time or thing that we say, okay, that happened, so that tells us, because honestly, non-US has done better than US year to date. And even today, non-US was outperforming US. So we don't really, there's always geopolitical risk, and that's why we're remain diversified. That's why you have fixed income in the portfolio.
All right, any other questions for Jason? All right, with that, then we will go on to, we do not have anything on item D. No action is needed, so we'll go to item E, which is the amendment to the trust statement of investment policies, guidelines, and objectives. Jason.
So we made a lot of modifications to this document that we discussed at a prior meeting. We didn't provide a red line because there was so much that we redlined and moved around. Essentially, 2 or 3 things. Nothing changed in purpose and scope. In Section 2, responsibilities of parties associated with the trust, number 1, we identified the trustees. The trustees weren't mentioned before. It was the trust. The trust itself is a thing. It doesn't have duties. So basically defining the trustees and what duties and responsibilities they had. The other parties around the trust would be investment managers, custodian, and the consultant. I think what we attempted to do was make this reflect actual practice and procedure. A couple of things that were talked about, and I'll highlight that in the with respect to the trustees. Really, all of the fiduciary obligations and decisions remain with or belong with the trustees. We did keep this language, may appoint an investment committee. This is in the trust document, the trust indenture. There is a provision that says that. We included it here. The other thing that we articulated is that you may delegate certain administrative functions to the city treasurer's office and staff, including changes in funding of investment managers and strategy, which is actually, I believe, how things happen. That they're the ones executing, so it reflects that. And with respect to other parties, it's just better defines how things are being done operationally. The next section, objectives and guidelines. This was a really long section, and it was broken down. You had U.S. equity managers, non-U.S. equity managers, fixed income managers, index funds. It was all different things. Really, this was intended just to focus on the total portfolio and what your objectives and guidelines are, what you can invest in, U.S., non-U.S. equity, fixed income, and real assets. It's in the indenture document. This language did not change with respect to judgments purchased by the city. The intent is to utilize investment, to have investment management done by external organizations. You're not internally managing things. The way the policy was previously written, there was a lot of language, most of the language on implementation related to separately managed accounts, of which you have none. So we took a lot of that out because it was just, it just wasn't clear, there wasn't a purpose for that. What we did say, and you see that in the top, number 2 at the top of the page, the trust may invest in mutual funds, which is what you're doing, and other collective funds, as well as separate accounts, while the preference is to invest in mutual funds or registered investment companies. And that's what you're doing today. But we didn't eliminate if a separate account or another type of commingled vehicle was less expensive or more appropriate, you could still do that. Asset allocation, this targets is representing what we just talked about, so better defining large and small and bumping up the target to non-U.S., defining fixed income simply as core and core plus, not high yield and active duration. So this reflects what was shown in the asset allocation. Performance objectives for the total trust remain the same. This section on investment managers, again, this was broken out into like 5 different categories. We just consolidated it into one. This is how we will evaluate all investment managers. Number 1, we expect them to stick to their knitting and do what they said they were going to do based on their proposed strategy or approach. Performance evaluation, it's measured against absolute return, relative returns, risk, consistency with style. We're going to compare them to the relevant index and peers. And then other areas that are evaluated include qualitative things, changes in personnel. This was articulated previously. So it's just really consolidating what was multiple places into one. Ethics and conflicts of interest, and these 5, 6, and 7 did not change. Other than we did change this to reflect the new name of the document, ACFR. It's just a different acronym is used for that.
All right. Any questions on the changes? Well, with that, then we will entertain a motion to approve them. Motion and a second. Record the vote. It passes unanimous. Jason, I just want to thank you so much for all your diligence and hard work on this, and
Yeah, I was just thinking the same thing. I mean, what a great cleanup. Thank you.
You bet. Thank you.
all right, let's go to item F. We'll ratify the claims from November 14th, 24 to January 28th, 25. Record your vote. Passes unanimously. Now we get to item G. As many of y'all know, on March 14th, our colleague Laura Johnson, who's been with the city for 45 years, will be retiring. as the Assistant City Manager, and we've got a resolution for her. We'll go ahead and do the resolution, then we can all say have our comments, because I got caught off guard. I was writing some things down just a minute ago with Jason. So with that, I'll turn it over to Mickey.
We don't have enough people to vote on that.
Well, the awkward thing is you're either going to get to,
I either have to vote on it or.
yeah.
Yeah,
I'm going to ask legal counsel if I cannot make a motion, okay?
kind of a little weird. I mean, I did think I've done a good job, don't get me wrong.
Okay. So we have a resolution recognizing and commending Laura A. Johnson for her service to the Oklahoma City Post-Employment Benefits Trust. Whereas Laura joined the city of Oklahoma City in December of 1979, and whereas Laura served the city of Oklahoma City for 45 years and will retire as an assistant city manager on March 14th, 2025. And whereas Laura is one of the original members of the Oklahoma City Post-Employment Benefits Trust, established on June 17th, 2008. And whereas Laura was the finance director when the city of Oklahoma City achieved a AAA bond rating. And whereas Laura helped establish and continually improve the Oklahoma City Post-Employment Benefits Trust. Now, therefore, be it resolved by the trustees of the Oklahoma City Post-Employment Benefits Trust that they do hereby recognize and commend Laura A. Johnson for her service and dedication to the Oklahoma City Post-Employment Benefits Trust.
All right, we got to do our formalities, and then we'll do the comments. So, and you do not have to touch this. I can actually do it, so no awkward moment.
I do still have to vote.
You do have to, well, you can vote no if you like, so. All right.
I showed up.
Now it passes unanimously. I would just like to say, when I think about Laura Johnson, in my 34 years with the city, I've worked with you for 32 of those years, pretty much. And when I think of Laura Johnson, I think as mentor, public servant, friend, advisor. I was in a situation not too long ago with my employees, and I was telling them advising them on something, and they asked me, "Did you talk to Laura Johnson about this?" And I said, "Yes, I did." And they said, "I can tell. You're handling this just the way Laura Johnson would." And so apparently, I think I handled it well. So
I hope so.
To be determined, though. It's to be determined. So advise her, encourage her, and she's diligent and she stays on top of things. And I can't thank her enough. She's like family to me. She's not only she's my boss, but she's like family to me. So thank you for all your diligence. She does get the credit for the AAA bond rating. She'll always get the credit for it. She's the reason we do things.
Hopefully I'll get out of here before we lose it.
Oh, now you're talking like I was earlier. So, but no, it's been a joy and a pleasure to work with you and work for you. And you're an awesome boss. Thank you for all your service.
Thank you. Thank you.
Chair, if I could, I also wanted to thank Laura. My less than 5 years with the city, but you have helped immerse me in what it means to be a public servant. And your counsel, your encouragement, your kick in the tail every now and again, they're all what's going to make the city great. And I just thank you for your service. I thank you for your partnership, your friendship, and I wish you all the best. But you are tip of spear of everything that's been great with the city. So thank you.
Thank you so much.
Would you like to say anything?
I appreciate you all. I appreciate your service to the city. I'm very proud of the work that we've done here as the Post-Employment Benefits Trust. I appreciate the administration work, the accounting work that gets done. We went into this, I went into this kicking and screaming. I don't know why we have to do this. We're never going out of business. We shouldn't have to pre-fund all of this, but it is very rewarding to look at what we've built here. And now that I'm about to retire, it's very assuring that this fund will be here for me to have health insurance, at least until I die 30 years from now. Thank you very much, Brent. But I am very proud of the work we've done here together. Thank you.
Thank you. All right, so we're now to item 4, comments from trustees, staff, and interested parties. Matt?
Just as with the passing that we've had with the investment policy and some of the updates there. We'll be working with ACG. There is the possibility of a special meeting between now and our regularly scheduled May meeting to potentially make some additional changes, but we will be in contact with there. And on behalf of the City Treasurer's Office, we as well congratulate Laura on all your leadership and on your retirement.
Thank
So.
you. Thank you, Matt.
All right, thank you, Matt. Now with that, we are at item 5 here at 4 o'clock. We are adjourned.
Yay.
Everyone be safe. Thanks for traveling.